Now, Regal Funds Management runs a long-short fund with stock picking at its heart. And for more on that strategy and how the team applies it to their pro bono work for future generation, James Sioud joins us. He joined us recently. We began by asking how Regal first got involved with Future Gen and why.
Regal has been involved with Future Gen for a number of years now. Phil King, our CIO and founder, originally made the decision for us to get involved, and it was really the work that Future Gen does for children in Australia, making sure that all kids in Australia, particularly those who are disadvantaged, get an equal opportunity to take advantage of this great country. And we just loved the way it was structured. It allowed us to continue doing what we're passionate about, but at the same time have that philanthropic benefit as well.
Yeah, what is that like in terms of you pooling your resources of some of the best fund managers in the country?
Yeah, I mean, there is a kind of leverage to it. A lot of the contributing fund managers have big, successful businesses who are sustainably generating good returns. This is a way for us to leverage that expertise and create good outcomes for the beneficiaries of Future Generation, the number of charities that do benefit from Future Gen.
And this comes at a time where Future Generation is celebrating 10 years.
Yes.
You've talked about the benefit that. What about the benefit to yourselves in terms of participating in that venture?
Look, it's a good point. There's obviously a benefit for the beneficiaries of Future Gen, but for people like ourselves, a lot of our job is quite abstracted away from the day-to-day economy, and this is a perfect opportunity for us to almost feel better about what we're doing and give us a bit more inspiration and a bit more reason of why we're doing what we do at work. When we come up with a good idea, it does feel quite inspirational for myself and for the team that we're able to express that view, create money for Future Generation, who are then able to donate more money to a number of charities who are targeting disadvantaged children in Australia. And that's a particular cause that we're passionate about. We do strongly believe that it's an important area to focus charity work, which is younger people. That is the future of this country and the future of society. So you do get that leverage from every dollar you can deploy in that part of in that charitable venture.
Well, you talk about those good ideas that you bring to the table. Let's talk about that then and that investment strategy that you apply to Future Gen.
Well, across Regal's funds, we are long-short fundamental stock pickers. That obviously involves picking stocks that are going up and betting against stocks that we think are more likely to fall over the preceding period. That's been our strategy since the inception of Regal 20 years ago. We have quite a large team based in Sydney and a team based in Melbourne, a team based in Singapore, and we leverage that large fundamental research team to come up with opportunities, idiosyncratic opportunities on the Australian stock market to generate good returns for all of our investors, including Future Gen.
How's that strategy panning out at the moment? I guess particularly given that market volatility and what we're seeing at a global level particularly.
Where we sit today, it's a particularly volatile week. Just this morning we had our Monday morning meeting, which we do every week, and we're talking about what we have in the following week. We've got a US election, we've got the RBA decision on Tuesday, FOMC, BOE, China fiscal policy update should happen, and of course we have the Melbourne Cup on Tuesday. So it's a very busy week with a lot of scope for volatility, but we think a lot of that volatility has already happened. We've noticed in the market a lot of degrossing, which means some of our competitors both in Australia and internationally have taken risk off the table heading into a particularly volatile week. So whilst there is the risk of upside or downside volatility in the next week or the rest of the year, we do think a lot of that is priced in at the moment.
All right, how do you approach asset allocation at this point then?
Yeah, I mean, we're purely equity stock pickers and we try not to focus too much on the macro. So the vast majority of our work is spent meeting management teams, meeting companies and coming up with bottom-up stock picks. That informs our top-down view, and it's what we're seeing at the moment is a lot of great opportunities in Australia, particularly in small caps. We think that we've gone through an extended period of passive investing becoming more and more important, and what we've noticed is a lot of money has left small caps and mid caps to go to large caps. So on asset allocation within equities, we think over the next 10 years, small caps and mid caps are going to be much more attractive relative to large caps. If you look at stocks like CBA, for example, that stock is more than double the valuation of its offshore competitors, and we think some of those that bubble per se in passive investing is very vulnerable at the moment.
So we have seen that rotation underway, or progress at least, into small caps, particularly now that the interest rate easing cycle is upon us, maybe a little delayed here in Australia. Nonetheless, globally, we're seeing that. But you're talking about a 10-year time frame.
Yeah.
Why are you seeing that opportunity in small caps over that period?
Well, markets run in cycles. We're about into the third year now of small cap underperformance, but over the long run, stocks go up, and over the long run, small caps do tend to outperform. But I do want to hazard, stock picking in small companies is very dangerous if you're using an index approach. It's not sufficient to just buy the index in small caps. Active management is particularly important with smaller companies. There's a lot more volatility in outcomes, a lot more variance in outcomes, and we think an effective research team with a strong fundamental focus is essential to taking advantage of the tailwinds that we foresee in small caps over the next few years.
So James, you've said you're very much bottom up.
Yes.
Nonetheless, sector-wise, are you favouring any at the moment, and perhaps others that you're seeing where you need to be underweight?
Yeah, so I alluded to CBA, for example. We do have an active underweight in financials more generally. It's not a sector per se, but if we looked at the larger cap stocks, we are underweight the very ASX 20 stocks and overweight kind of X100. So they're our two main underweight positions at the moment. In terms of sectors we're particularly excited about, one I would like to call out is tech stocks. We have an abundance of high quality growth stocks on the ASX who are very, very early in their global growth aspirations. So these are companies that we see can easily double in the next year or two, and on a 5-year view have potential to grow by multiples where they're currently trading at today. So they're stocks like Life 360. We also like the materials space at the moment. So I'm not an expert in mining, but we do have an expert team at Regal who help us make stock-specific decisions in mining. We particularly like the copper space, the uranium space, and the gold space. There are some commodities that are excessively exposed to China. It is good to see the Chinese government starting to stimulate, but we're not getting too bullish there yet. So they're commodities like iron ore and lithium. So that's at a high level, how we're currently expressing our view through the portfolio.
And James, you mentioned those tech stocks, for example, Life 360. How are you playing that AI thematic at the moment, or do you think perhaps it's a little overdone?
Yeah, there's a lot of ways to play the AI thematic. You can express it through on ASX data centers. The more exciting pure play exposures are in the United States, which we don't have access to here, but we're more focused on the picks and shovels play. So one stock we do like is Macquarie Telecom. It's a data center company, or it's actually changed its name to Macquarie Technology recently. That's a Sydney-based data center company that's trading at a lower multiple versus other data center companies in Australia and offshore. So that's one exposure we quite like. I think over the next few years, there's going to be more opportunities to profit from this AI trend, not just on the long side, but also on the short side. We're going to see a lot of industries get disrupted, and they're often, if you look at previous technological waves, it's often easier to make money on the short side than it is on the long side. So we're trying to be very balanced in how we approach it and just observe trends rather than try and pick them too early.
And given how AI is touching every corner of society at the moment, does that include funds management? Do you see it as a potential challenge or an opportunity?
I think everybody thinks their job's safe, but I think the one thing that AI can't do yet is express creativity, and that's actually a big part of funds management. If something's obvious, it's usually in the price. A lot of people analyse too much and think too little. I think that's what AI is. It's leveraging and analysing what other people have already done. I think that the only way to generate alpha in the stock market is to think independently and to be creative. So hopefully that's not on the horizon, but the early signs are these AI tools are going to be helpful in my day-to-day work. So for example, you're now able to upload an annual report and an Excel file to ChatGPT and ask it to run some numbers for you. Now it's very, very confident, but it's often wrong. So I'm not recommending anybody try this at home, but early signs are it could be a useful tool.